Is your investment portfolio more prepared for a recession than your pantry was for the 2020 toilet paper apocalypse? Right now, Wall Street's favorite economic crystal ball, aka the yield curve, is doing its best impression of a horror movie villain. And spoiler alert, it's not screaming, buy the dip. Hi, I'm Captain Clue, a qualified government accountant and finance specialist. I've worked in everything from voluntary corporate actions to mortgage lending. Stick around. This is the financial survival guide you didn't know you needed, but definitely do. Before we go further, the yield curve, the financial world's version of that one friend who says cryptic things like interesting times ahead and then walks away, is making headlines on CNBC, keeps popping up in your broker's emails, and honestly sounds like something from a high school math test you purposely forgot. But don't worry. By the end of this, you'll finally understand why economists are sweating over this squiggly line, how it could mess with your money, and most importantly, whether you should panic buy stocks or just panic eat ice cream. Stick around. This is the financial survival guide you didn't know you needed. All right, so what exactly is the yield curve? Well, to begin with, the yield curve isn't some obscure economic theory. It's actually just a graph, a simple visualization that shows us something incredibly valuable, the relationship between interest rates and time. When we talk about yields in investments, we're referring to how much you get paid from your investment as a percentage of what you put in. With stocks, this would be your dividend yield, the dividend payment divided by the stock's price. But the yield curve specifically looks at bond yields, particularly U.S. Treasury bonds. These are bonds issued by the U.S. government and are considered among the safest investments in the world. Here's how it works. On the vertical axis of our graph, we have yields, basically the interest rates you'd earn. On the horizontal axis, we have time, specifically how long until the bond matures or comes due. So we might look at treasury bonds that mature in 3 months, 2 years, 5 years, 10 years, and even 30 years. When we plot all these different bonds on our graph, connecting the dots gives us our yield curve. Next up, let's talk about what a normal yield curve looks like and why it usually slopes upward. This means longer-term bonds pay higher interest rates than shorter-term bonds. This makes intuitive sense, right? If you're locking your money away for 10 years instead of 2 years, you'd expect to get paid more for that commitment. And there's actually a term for this, the liquidity premium theory. It suggests that investors demand higher returns for longer-term bonds because they're taking on more risk by having their money tied up for longer periods. Think about it this way. Let's say you have two investors. One buys a 2-year government bond and another buys a 10-year government bond. Now imagine that after 18 months, the government starts issuing new bonds with much higher interest rates. The investor with the 2-year bond isn't too worried. Sure, the market value of their bond might fall a bit, but in just 6 months, they'll get their principal back and can reinvest at those new higher rates. But the investor with the 10-year bond, they're stuck. They can either sell their bond at a loss, since it's now less attractive compared to the new higher rate bonds, or wait another 8.5 years earning below market returns. That's opportunity cost, and it's real. So longer term bonds typically offer higher yields to compensate investors for this reduced flexibility. When the yield curve looks like this, sloping upward from left to right, economists call it a normal yield curve. It suggests that investors expect steady economic growth and rising interest rates over time. But here's a shortcut some analysts use. They don't bother with the full curve. They go straight to one key metric called the yield spread, which is simply the difference between the 10-year treasury yield and the 2-year treasury yield. For example, if the 10-year bond yields 3% and the 2-year bond yields 2%, the spread is 1%. This number gives us a quick snapshot of the curve's steepness. A wider spread, like 2% or more, indicates a steep curve, while a narrow spread, like 0.5% or less, signals a flatter curve. Here's where it gets interesting. Sometimes the yield curve flattens out, and that's when people start to get nervous. A flattening yield curve can happen in two ways. 1. Short-term yields rise, and the left side of the curve moves up. 2. Long-term yields fall, the right side of the curve moves down. The Federal Reserve has significant control over short-term rates. When they raise their benchmark rate, as they've been doing to fight inflation, it directly pushes up yields on the short end of the curve. But what causes long-term yields to fall? This is where investor psychology comes into play. When investors start worrying about economic growth, they often buy more long-term bonds as a safe haven. As demand for these bonds increases, their prices go up. And remember, when bond prices rise, their yields fall. So a flattening curve can signal that investors are becoming pessimistic about future economic prospects. They're essentially saying, I'm so concerned about the economic outlook that I'm willing to accept lower returns just to lock in a safe investment for the long term. Moving on to the next stage. When flattening turns to inversion, that's when alarms really start ringing. If this flattening trend continues, we can end up with what's called an inverted yield curve, where short-term bonds actually yield more than long-term bonds. This seems counterintuitive, but it happens when economic anxiety reaches fever pitch. An inverted yield curve essentially means that investors believe interest rates will be lower in the future than they are now. And why would rates be lower? Because the Fed typically cuts rates during economic downturns to stimulate growth. In other words, an inverted yield curve suggests that investors collectively believe a recession is coming. But here's the kicker. This isn't just market noise. The yield curve has a serious historical track record. Looking back at economic history, a flattening and ultimately inverted yield curve has preceded nearly every U.S. recession in the past 60 years. Let's look at some examples. Before the 2008 financial crisis, the yield curve began flattening in 2005 and eventually inverted in 2006 to 2007. 2001 recession following the dot-com bubble, the curve gradually flattened throughout 1999 and inverted in 2000. Finally, the same pattern appeared before the recessions of the early 1990s, early 1980s, and mid-1775s. The track record is impressive enough that economists and financial professionals watch the yield curve like hawks for signs of trouble ahead. So, why does the yield curve have predictive power? And what does this all mean? Why does this simple squiggly line freak economists out so much? There are several reasons why the yield curve works as a forecasting tool. First, it captures the collective wisdom of the bond market, which includes some of the smartest money managers and financial institutions in the world. Second, a flattening yield curve can actually help cause a recession through what economists call a self-fulfilling prophecy. As the curve flattens, it squeezes bank profits, since banks typically borrow at short-term rates and lend at long-term rates. This can lead to tighter lending standards, making it harder for businesses to get the capital they need to expand. Third, an inverted yield curve signals that monetary policy may be too tight. If the Fed has raised short-term rates to the point where they exceed long-term rates, it suggests they may have gone too far in their fight against inflation, potentially choking off economic growth. So, what should investors do about a flattening yield curve? To recap, trying to time the market based solely on the yield curve rarely ends well for most investors. If you're investing for the long term, trying to time the market based on the yield curve or any other single indicator is probably not the best strategy. Studies consistently show that market timing is incredibly difficult, and missing just a few of the market's best days can significantly reduce your long-term returns. Instead, here's what prudent investors should consider. 1. Diversify your portfolio. Make sure you own a mix of assets that don't all move in the same direction at the same time. This might include stocks, bonds, real estate, and perhaps some alternative investments. 2. Check your emergency fund. Economic downturns often come with job losses and income reductions. having 3 to 6 months of essential expenses saved in a readily accessible account can provide crucial financial security. Here's how to stop your future self from face-palming at your bank statement. Finance Fiascos Volume 1 Raw Confessions plus mind map PDFs for bite-sized quick review of these videos. Use code CLUE10 for 10% off today only. 3. Review your risk exposure. If you're nearing retirement or might need access to your investments soon, consider whether your current asset allocation aligns with your time horizon and risk tolerance. 4. Focus on quality. In uncertain times, companies with strong balance sheets, stable cash flows, and competitive advantages tend to weather economic storms better than their weaker counterparts. And 5. Look for opportunity. Market downturns, while uncomfortable, often present excellent buying opportunities for long-term investors. Having some dry powder, cash, ready to deploy during market dips can enhance long-term returns. The key takeaway is this: don't make drastic changes to a well-thought-out investment plan based solely on the yield curve's movements. Instead, use this information as one factor among many to ensure your financial house is in order. Remember, the yield curve is just one of many tools in the economic toolkit. Now, the yield curve might steal the spotlight, but it's not the only economic indicator worth keeping an eye on. You'll also want to watch things like unemployment rates, job growth, consumer spending, and retail sales. Manufacturing activity, housing trends, and corporate earnings also tell us a lot about where the economy's headed. And don't forget the leading economic indicators index. It's like a dashboard of warning lights for the economy. So while the yield curve is important, it's just one piece of a much bigger puzzle. No single indicator can paint a complete picture of where the economy's headed. That's why economists and market strategists look at multiple data points to form their outlook. The yield curve may seem like a simple graph, but it offers powerful insights into investor expectations and economic prospects. Its flattening pattern has historically warned of economic trouble ahead, though the timing and severity of any downturn remain uncertain. Rather than trying to predict exactly when a recession might hit, a notoriously difficult task, focus on building a resilient financial plan that can withstand various economic scenarios. Diversification, quality investments, and a long-term perspective remain the bedrock principles of successful investing. Remember that markets have weathered countless storms over the decades, and patient investors have been rewarded for staying the course. The yield curve is a useful tool in your financial knowledge toolkit, but it's not a crystal ball that should drive hasty investment decisions. Understanding the yield curve puts you ahead of most investors who either don't know what it is or don't appreciate its significance. By recognizing its signals while maintaining perspective on its limitations, you can make more informed financial choices for your future. If this helped you make sense of the madness, give it a like, hit subscribe, and turn on those notifications.